Preferred shares have seen 7 consecutive quarters of gains, but can that run continue, or are things looking a bit stretched? Joining us now to discuss is James Hunter, VP, Director and Portfolio Manager with TD Asset Management. Great to have you back on the program.
Thank you, Greg. We've got our summer ties on.
We've got our summer ties. We're looking nice and airy and bright. We're going to keep the conversation airy and bright about preferred shares. 7 consecutive quarters. That is quite the run. Still a healthy risk reward out there in this space, or are we getting a little stretched?
Yeah, I mean, it's been awesome. We're up about 10% year to date. That follows last year. I think we're up 25% on the year. So it's been a continuation of a nice recovery in preferred shares. What's really going on is a scarcity effect. You're continuing to see a lot of redemptions in the market. The banks have been very active in redeeming some of their preferred shares at par, but it's not just the banks, it's also the insurers, some of the utility companies, even in the energy space. We had $6 billion in redemptions last year, $2 billion so far this year, another $1 billion to come. So like 20% of the market in a bit of a hurry in the last year or two. So yeah, it's been pushing prices higher. And at this point, I'd say the risk reward is balanced. Like you're getting a good 5% yield. Prices could go higher because of these redemptions that are ongoing in the market. But on the other hand, something unexpected could happen that could take the market a little lower. So we're sort of neutral on the asset class at the moment.
I know unexpected by its very nature is hard to define, but what could be a catalyst that could take the market lower? What kind of things usually hit prefers?
Yeah, so it would be something to do with the economy that would drive central banks to maybe cut rates or for the bond market to price interest rates lower. And we saw that in April with you call it the tariff tantrum with Liberation Day and what followed thereafter. I mean, the market was really worried that we were going to move quickly towards a recession, and that's an environment that's not good for preferred shares, partly because issuers would be making less money in a recession, and also because as interest rates come down, that really affects the prospective outlook for dividend payments on rate resets preferred shares. So that's the thing that we're always looking for. By its nature, it can be hard to predict, and so that's why it's important to be disciplined about the pricing that you're paying for preferreds.
Those are the possibilities, the reality we have been living through with those 7 consecutive quarters of gains. You mentioned that some prefs are approaching par. What's the significance of that for somebody who's not sure about prefs so far?
Okay, so important to remember that preferred shares, when they're issued, they come to market at $25 per share here in Canada. And what we've seen since this asset class really became much bigger in the last 10 to 15 years, they average around $21 a share. So sort of like a 15% discount to par. And that's because sometimes they trade at $25 and sometimes they trade at $17, $18 a share. It could be like a 25 or 30% discount when we go through those periods of uncertainty. And we've seen that before in 2015 when oil prices collapsed. They didn't go to zero that time, but they went a lot lower. That was a drag on the Canadian economy. We saw it in 2020 in the pandemic, and then in 2022, 2023 with all those rate hikes and fears around recession. So during those periods, preferred shares can trade a lot lower than their par value. So it's important to be aware where you are in that cycle. Right now, we're overshooting a little bit the long-term averages. That's okay because it's supported by fundamentals around redemptions and corporate profitability. So we're not worried about it, but on the other hand, we're just cognizant that the risk reward isn't as appealing.
Yeah, we've had interesting conversations on the program about the equity side of this. No shortage of worries on the economy. Equity markets don't seem to be worried. When you talk about these redemptions, what's happening here in the redemption space?
Okay, so when we talk about redemptions, the primary driver here is a substitution away from preferred shares towards other types of capital for primarily the banks, but also the regulated insurance companies. They are calling back their preferred shares and they're moving to something called limited recourse capital notes. The interest payments they make on those securities are tax deductible for them, so it's a lower cost of capital, lower cost of financing. There are also, in other parts of the market, the pipelines, the utilities, they have the ability to offer hybrid securities. Also, it's sort of like an alternative to a typical corporate bond, tax deductible, so it can be more competitive for them. So there are options for the issuers that are basically cheaper. So they're going with those and they're calling back their prefs that if they had reset them, would have cost them a lot in terms of the dollar amount of dividend payment and the implied coupon on a dividend rate on those prefs. So that's the driver. And like I said, it's been significant. We had in the 2010s many years of $5 billion or more a year of issuance, and we've seen the opposite in the last couple of years. There's been absolutely zero issuance for many years, and these redemptions have been running at many billions a year because of that substitution effect. And what it means is that buying spills into the remaining preferred shares in the market. That's a good thing for anybody who owns those securities. So it's been pushing prices higher.
Pushing prices higher in the here and now. If this trend continues where these big issuers, traditional big issuers or preferreds, start going to these other funding vehicles, what does the preferred market look like a year, 5 years, 10 years from now?
Well, it looks smaller, which is a double-edged sword because you want ideally a growing, liquid, you'd call it healthy market, but it's not as if really things have changed in the remaining parts of the market. The banks and insurance companies have really never, it's almost weird to say it this way, but they've never been doing better in terms of record corporate profits. The concerns about a recession and sort of unemployment inching up notwithstanding, they're legitimate things to consider in that arena, but capital generation is really good. Margins are good, and the businesses are pretty steady right now. We've seen good dividend growth as well from the banks and insurance companies. So that part of the market is stable. And then if you look at the pipeline, the utility companies, some of the other parts of preferred shares, we've got good growth projects, probably more than we've seen than in the last 5 or 10 years. If you think about power demand, that's a big theme in North America right now. Lots of natural gas projects as well. So that's an area where the utility companies can grow. So the remaining parts of the preferred share market are healthy. It's just that it may not be as big as it used to be in the past, and it can be frustrating from a liquidity perspective, but it's positive in terms of pricing because of the scarcity.
Okay, quickly I'm going to ask you, for someone who's just getting new to preferred shares, trying to figure out what role it could play in a portfolio, what role can it play?
Primary role is income. There are very, very few ways to get such a tax-advantaged yield. Now, often we would look to corporate bonds for income, and that's absolutely correct. The thing is that you don't get a dividend tax credit on your corporate bond coupons. So for a retail investor, those tax credits have a lot of value. The other areas where you can get income would be in the income-oriented parts of the equity market. But yields have come down because the stock market has really roared off the bottoms in April, and dividend yields might be in the 2 to 3% range on the TSX rather than 5% plus in preferred shares. I mean, it's a very meaningful difference. The other factor, of course, is GICs and cash in the last few years. You used to be able to get 4 or 5% on those short-term cash instruments, but as the central banks in Canada have cut rates, those yields have come down. So preferred shares are this shining light where yields are still quite appealing, and the dividend tax credits are there. So the role in a portfolio is income. There is also supposed to be an element of diversification because it's a hybrid between stocks and bonds, and that's sort of how we look at it. And in many of our income-oriented portfolios, it's sort of a 5 to 10% weight, and that's what we're going for. It's the income.